Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. And turn it is doing right now. Lots happening this week. A lot of information came out the past couple of days. We'll get to it right now. Today is Friday, May the 17th. Hope everyone's doing well. Let's get into it. So the number one news, at least from my perspective, is that Adam Data Solutions released its April 2019 U.S. foreclosure market report. So that's always interesting to see what's going on. And this shows foreclosure filings, default notices, scheduled auctions, and bank repossessions. And what they basically said that in April 2019, they felt that this number of all those activity was down 5% from the previous month and down 13% from a year ago, so year-over-year decline, for the 10th consecutive month of an annual decline. Now, while the overall foreclosure activity is down nationwide, there are still parts of the country that we need to keep a close eye on, according to the Chief Product Officer at Adam Data Solutions. And, for example, he says Florida has seen a steady annual increase in foreclosure activity for the 8th consecutive month, which is being sustained by constant annual double-digit increases in foreclosure starts. So just to step back here, when we talk about the overall foreclosure activity, that starts, notice the defaults, that's repossessions, that's auctions. So that's a lot of activity, but it doesn't always paint the true picture because we know what happens with the auctions and the repossessions, etc. We know what's going on there. To me, what the real trend line is the activity on the foreclosure starts, the actual filings to start the foreclosure process so the lender can obtain their home. So to me, that's more of a telling situation with respect to what's going on in our current marketplace. So having said that, foreclosure starts increase annually in 17 states, which is very interesting. So counter to the national trend, which in this case the national trend is decreasing activity, annual increase in foreclosure starts for states included Washington, up 38%, Florida up 34%, Oregon up 22%, Louisiana up 12%, and Georgia up 11%. So interesting to note that we have two West Coast states, being Washington and Oregon, which are up pretty significantly. And just as a side note here, you may have read this in the news, but Louisiana is really supposed to be the most the most state, I guess you could say the most applicable depreciating opportunity state out there. So more locations in Louisiana are suffering from distressed property, foreclosure starts, and negative growth. So if you wanted to invest in a place that's actually on the way down, that's a place to actually look at it. Highest foreclosure rates, and again, when they talk about rates, they talk about per capita, how many filings per household. Highest foreclosure rates, states with the highest foreclosure rates were New Jersey, Maryland, Delaware, Illinois, and then Florida. So we got a little bit on the East Coast there, one in the Midwest, and of course one in the South here. So very interesting. Other locations that were they wanted to note, and Adam Data Solutions breaks this down into state level, into population of 500,000 above, 200,000 and below, things like that. I actually inquired to see if I could get my hands on the data reports, and they are literally hundreds of dollars to get a snapshot. So unfortunately not worth me getting. We'll just talk about, and of course what they're just talking about in their articles is the top highlights, etc. But just so you realize that, love to get it, but just not going to spend the money on something that's going to change every month like that. But interesting notes that Atlantic City having a hard time, Fayetteville, North Carolina, Clarksville, Tennessee, Columbia, South Carolina, and then Deltona, Daytona Beach, Florida. That's smaller cities that are having higher, I guess you could say, higher foreclosure start activity. And they say foreclosure completions continue to decline. And lenders completed foreclosures, on less 22% from a year ago. It was down. It's a sixth consecutive annual decline. And again, as I mentioned that, we spoke about the fact that homes don't necessarily get to go to foreclosure or to the auction because of some of the things that these lenders do to really transfer their losses or transfer the opportunity to other institutional buyers. So, when you hear this information, I don't go, ooh, there's all these things happening and the economy's better, etc. I think there are other things behind the scenes going on. In fact, I know that that actually makes these numbers look better than they actually are. So when you see decrease in REO volume, it's because they've sold it to somebody else. So the lenders aren't taking it back themselves. They've just moved it to another entity who will deal with it how they want to as they go forward. So just something to be aware of here. So having said that, I want to move on to, there was something called the Capital Exchange Summit, which is going on right now or this past week, and it's obviously an economic summit, but the incoming Freddie Mac CEO was interviewed with, along with Taylor Morrison, that builder CEO, and they had a few things to say, so I watched the video. So interesting enough, this sort of everything comes into play. So he said, obviously, we have a lack of supply. We don't have enough housing, nothing being built except A-class multifamily structures. So it's therefore still those are not affordable. That's not hitting the affordable market. The A-class is more of a luxury apartment market. He said, we need to have 1.5 million units built a year, and we're trending under 1.2 million units, so we're at a deficit. And he said overall there's a deficit of 4 million homes are needed to meet housing needs, and we got a huge deficit. So we're not there. Obviously we're not going to get there for many issues. And then again, his talk, obviously there was the CEO of Taylor Morrison beside him. So they're focusing on building and the issues, when you don't have enough, when land is expensive, when materials expensive, all those things have gone up. It drives prices up, and in turn drives rent up, as a byproduct. So guess what? Everyone's paying more and nobody can get affordable housing, etc. So there seems to be a lot of issues, and everyone acknowledges lack of affordable housing, but no one seems to acknowledge or figure out a way how we can move to solve that, which is the problem in itself. But just interesting to note that it's being talked about. But funny enough, you got the incoming Freddie Mac CEO, which is basically part of the government. They're part of HUD, Housing and Urban Development, and the government-sponsored entity that's GSE. So ultimately, they're involved in housing. He says, I'm not involved in housing policy, but he kind of really is, or they are in a way in how they handle the marketplace and what they can do for it. So when they, if they're saying we have lack of affordable housing and we have issues going along with that, next brings me to the fact that, okay, Fannie Mae just announced the other day, a couple days ago, that it was going to sell another set of non-performing loan pools. So basically what they're doing is they've got 6 larger pools of approximately 4,660 loans totaling $822 million in unpaid principal balances that they're going to sell off to essentially bidders, which typically are investors, hedge funds, or whatever. So now, what they do is sometimes they carve out other little pools too. There's one pool of maybe 17.7 million, which they try to carve out and keep for nonprofits or other type of qualified bidders that could help local, a little more local in perspective. But the whole deal here is that when you've got one part of the government saying that, oh, we have affordability issues, and okay, as a byproduct of that, what do? They raise debt to income levels, they bring down payments down so more people can afford unaffordable homes and put themselves at risk. So they're saying on one hand we don't have affordability of homes, yet another government GSE, government-sponsored entity on this side is basically saying, well, we don't want to deal with these non-performing homes, so we're just going to let them go and cover our losses and let them go to other people who essentially will do with them what we want them to do, which is take care of them, take them off our hands. So the fact of the matter is when they sell these non-performing loan packages, and they sell them periodically, a few times a year, and they're typically in that close to $1 billion or above billion range, and also Freddie Mac just did some back a couple months ago, and they will do this continually. The issue is that these homes don't get to be either foreclosed on and come back on the market as cheaper property for the average public to buy. They're not pushing the short sale opportunity or encouraging that as a solution. So therefore, off it goes. Now, I want to qualify though that part of the whole non-performing loan situation here is that the transactions require the buyer of the non-performing loans to pursue loss mitigation options that are sustainable for borrowers. In the event a foreclosure cannot be prevented, the owner of the loan must market the property to owner occupants and nonprofits exclusively before offering to investors, similar to Fannie Mae's First Look program. Okay, well, I know what happens here is that they're going to treat this their own way. They're probably going to offer the homeowners here cash for keys for what's done as a deed in lieu of foreclosure, to have them leave the house. Therefore, it doesn't actually go to an auction. They can do what they need to do, repackage it, typically fix it up, or put a renter in the whole bit. So even though that the government's saying you need to follow our loss mitigation strategy, well, you know what? In the end, I can tell that that's not what is happening, and the intention of a lot of these hedge funds aren't to complete these potential short sales or offer that or whatever. They're still going to be operating as really a for-profit entity and doing what they can. I've got personal experience in this. I want to give you a little bit of a heads up on this. So what happened? We this is a few years ago, but we were engaging in a short sale on a property, and it was with a large bank, and of course it was an FHA backed loan. So we're cool, and we actually had an approval to move forward with the short sale. And then as we were trying to get everything tied up for closing, we were informed that the lender doesn't have it anymore. It's been transferred to a hedge fund. So therefore the short sale just disappeared. We had a buyer waiting to purchase it who just couldn't buy the home now, and everything kind of was in a mess. So of course, the lender we were dealing with, at the time had approved the sale price off, and everything was great. We were waiting to close. So what happened is the new hedge fund gets involved, and they will not honor what was approved by the bank previously. They wanted $40,000 more for the property, which didn't make sense. And after we told them that, we couldn't, our buyer's not going to cut $40,000 just because you want it to, when we have an approval and we have the appraisal and everything lined up. So they said, well, we're not going to honor that sales price. Oh, and by the way, do you think you could get the homeowner to sign a deed in lieu of foreclosure for us? So to me, right there, what was an indication of these guys that come in and purchase these non-performing loan pools really. And again, I'm broad brush stroke painting here, but I think that it's happened more than once to us. But the point though is that their intentions aren't that. Their intentions are to use the asset to make money on the asset. Simple as that. And I can tell you that a lot of this loss mitigation strategy is not happening because it just won't. If it wasn't happening beforehand, it's not going to happen now. And ultimately, in the end, homeowners who are in these non-performing loans will end up giving their homes back to the lender and moving on, or doing some sort of maybe rental package with them, etc. So again, I don't think it's the best setup for a homeowner. But again, that's just my perspective on things. So that's how this kind of works. So we see this periodically. We see these sales of non-performing loans. Some of them are called community impact pools. Those are the ones that focus on some maybe smaller areas, less homes, in a strategic geographic area designed to sort of bring the condition back up at the lower income level. So that's what goes on in the marketplace. Be aware of that. So which leads us to housing starts. So the housing starts for last month suffers a seventh annual decline in a row despite a surge in the Northeast. So housing starts spiked 5.7% month over month in April, but it was still less than the 6.2. But in the end, everything was still lower year over year. So we got the bad news was that housing starts fell year over year for the 7th month in a row, and building permits for single-family units tumbled to its weakest since October 2016. So again, talking about that economic summit we were talking about, Taylor Morrison, CEO, basically said that new housing sales kind of ground to a halt in 2018, and end of 2018 it just kind of stopped, and all the builders have all this inventory and they don't know what to do with it. So that really scared them and kind of freaked them out, because never had such a hard stop in home sales actually occurred since the last housing crisis. Now, if I recall, probably a couple months ago, the new home supply chain was about 7 to 7.5 months worth of supply, which again, we have 6 months as our generic, balanced buyer market, seller market. So these guys have over 7 months of supply, which means there's more inventory out there if you wanted to buy the homes. Still going back to the affordability, we know that new home prices declined last month about 10 or 11%. They're still holding on inventory, and they're not going to be building spec homes as much as they used to back in the day, just because they can't do it. Of course, they also talked about the the entitlement costs, land costs, development costs, material costs, the whole bit, things like that. The tariffs that are put out there now, it's expected that'll affect the home renovation market as well too, because materials will jump in price. Home flippers, I didn't even pull the article on this, I just watched the video. There's the guy from one of those flipping shows out in California. His name is Tarek Al Musa, and he was interviewed, and he basically said, yeah, his construction costs essentially have doubled. So, he can't sell the property for more than the market allows, but his construction costs certainly, he goes, have doubled. So he has to be careful on how he does things and what he does, which is indicative of, flipping homes is going to become less and less lucrative as time goes on due to some of those things. He mentioned the same stuff we all know about. Material prices skyrocketing, skilled labor, less skilled labor available, and more skilled labor costing more money. So in the end, everyone's getting pinched and squeezed here, and we'll have to see what happens in the very near future. Which brings us to something interesting I saw. San Francisco, a dilapidated home in a certain neighborhood of San Francisco is on the market for $2.5 million. The 640 square foot home isn't safe to enter, but it comes with two things that explains its staggering price tag: a view of the city and a demolition permit. So apparently the city's planning department has already granted permission to demolish the structure and replaced it with a 4-story, 4,400 square foot building with 4 bedrooms, 4 bathrooms, 2-car garage, and private elevators. Wow. It can be built as either a 1 or 2 unit building. It took its owner 2 years to go through the permitting process. However, the new owners would need to obtain a final building permit to start before construction. So now the person who did this, who owns it, bought this for $1.5 million back in September 2016. So they're basically saying, hey, all the work this is basically a tear down in a nice location with a great view, and I've done all the work for you, so you can just walk in and just get it approved to build a 4-story, 4,400 square foot plus, home, but it's going to cost you $2.5 million just to obtain the land and I guess the building permits or the plans, whatever that's been approved and designed here. So that doesn't cover the cost of the build. So think about that. So this is where you kind of go, what's going on in the marketplace? People are still trying to aim high and get as much as they can, which I don't know. They call these things little crap shacks, and 640 foot crap shack, demolition, $2.5 million. Then you got to build probably another, $1 million minimum. I don't know what the prices are for doing something that big out in San Francisco. And my assumption is just probably, engineering things on the hills and seismic stuff, whatever, that have to be considered. That would probably be more costly than an average house down in my area. But again, just really interesting to see people are still going to try to, hit the home run as much as they can. Which brings us to the next interesting thing. California wants to ban single-family zoning, and the whole idea is that as everyone, as population grows, or as there's more buyers and renters coming out, like 2/3 of the land in California basically is zoned for single family use. So basically this does not address the current and ongoing housing growth and affordability needs. And so California is, I guess, a mulling the state measure that would require cities and counties to allow permits for duplexes, triplexes, and fourplexes on much of the residential land that is actually zoned for single-family home. So the proposal has been added to Senate Bill 50, and that's what it's going to do. So that's just been put in there. It's not approved yet. It's going to go through the motions, but so that's an interesting, I guess that you could say, play in the fact that let's make our property more dense. Let's if we can build the same size structures, but instead of making a single family home, we've made it 4 units. Well, guess what? Now we have, in theory, 4 families or four entities who live there, who are able to either buy or rent, which you would think would reduce the cost profile of building something there, so that would be, and therefore could it be more affordable? Who knows, right? We'll have to see if that works out. The flip side of this, though, is the fact that if I'm in an area and I've just spent $2.5 million and to build my beautiful 4,400 plus single family home, 4-story with a great view, and then my next door neighbor can knock his house down and put a fourplex there, that devalues what I just spent a premium to put up myself. So zoning is very particular, and zoning is basically similarity. That's what it boils down to. The next house is the same zoning as the next house. Therefore, the whole idea is to keep consistent with the urban planning, the services, and also the house values. So that's, to me, I think this is interesting that they're going down this path, but it's certainly going to open up a lot more issues, comments, and questions as time goes on. But they started it. Okay, and let's see what I got. A couple more things here. Interesting note here, and this goes to show how our market is changing. And I'm going to call. I have another cat. That's not Bubble Kitty. It's another cat here, in case you hear him. It's what I call the market disruptors, real estate disruptors. So we talked about the iBuyers last video and how they're coming into various markets and they're essentially disrupting the buy and sell process, which hurts a lot of entities and groups out there. The whole idea is that they're servicing the client the best they can. As a homeowner, you've got choice now. You don't have to go with the traditional real estate model. You can go with whatever. So this is kind of down that path here, and I found this very interesting. So there's a lot more chaos in this sort of, we'll call it, intelligence market of real estate. So Baltimore City is now under a cryptocurrency ransomware attack, which has paralyzed the real estate industry. So basically what happened is a new report from the Baltimore Sun shows that a hack has disrupted the city's servers for an 8th straight day, and the essential systems required for transacting real estate deals have gone offline, throwing the entire industry into chaos, which means no homes can be bought or sold. And why is that? Well, because they can't issue title insurance. So I guess the real estate transactions have ground to a halt because title insurance companies cannot access city servers to verify properties are free of liens and to create a new deed. So there you go. You can't view the history to offer title insurance and make sure and provide free and marketable title to the new buyer, and then you can't record deeds and stuff, which is not good. So I think it's very this is not a good thing. It's not. I mean, I always think things are interesting because it shows where we're moving to in the future, but it's very it's kind of a weird situation here. So what does this mean? Well, apparently there's 1,500 pending sales right now in the city of Baltimore, and the attack is expected to halt dozens of transactions this week, if not more. Real estate agents have already said people have canceled. So think about this: you're looking to buy a home this weekend, and move, and it's a domino effect. So maybe you're selling your other property to buy this property. You can't do either, so it creates a domino effect for buying and selling, etc. So we're going to see a lot of issues happen because of the domino effect. We're going to see loss of revenue for the city and the county. We're going to see loss of commissions for agents. We're going to have loss of income for title companies and things like that. So as a result, these transactions, 1,500 pending. When this is all over, probably not going to be 1,500 pending transactions. We're probably going to see a decrease because we're going to have canceled sales as a result. And what can you do? It's one of those things where it's not the buyer's fault, it's not the seller's fault, it's the fault because we've got something that is sort of like above and beyond the situation here. And clearly every real estate contract has some clauses that state, well, if in the event we can't close because of what's called force majeure or whatever, things that are beyond our control, that there should be some give or take on both the buyer and seller sides. But in the end, there'll be things that will override that. People will go, well, I needed this something to happen, I can't do it anymore, and I, whatever, my home didn't buy, which was a contingency to buy your home, or didn't sell, which is a contingency to buy your home, or prices change. Like, who knows what's going to go on? But my point is, look at how this has disrupted one city, and it could have some significant effects, not just from buying and selling, but all the other entities and all the other services and suppliers that are affected with a real estate transaction. So maybe this is the start of something in the future, but it brings to light the fact that clearly this has not been contemplated by the cities and the counties, and they're going to have to figure this out. So really, the ransomware is it's basically whoever did the hacking wants cryptocurrency as a ransom to remove the malware and the hacking, and so they can perceive as possible. So knowing what are you going to pay that, and they're going to do it to you again. I mean, come on, or extort you even more. So it's just a situation. So at this point in time, they have no idea what to do and how they're going to work around this, which is very interesting. All right, last but not least here, a little bit about Airbnb. Sort of going down the path of the IPOs, initial public offerings. We've seen a couple, with Lyft and Uber and things like that. There'll be more coming up. Airbnb is planning on an IPO later on this year. I find that always the dirty laundry of things tend to come out just before IPOs, and that's again another disruptor. How it affects real estate. Well, it's how many millionaires will be hitting the Silicon Valley marketplace, buying expensive homes and jacking up prices based on their stock options. So we'll see what happens in the next little while. But the issue is that 1 in 10 Airbnb guests report that they've discovered hidden cameras in their short-term rentals. So, yep, this is a big deal. So you go to get a nice little loft or something, Airbnb, when you're in a little vacation area and people are watching you. Now, Airbnb apparently does permit cameras in certain locations, perimeter cameras in the general living and common areas. They do not permit cameras in bedrooms and bathrooms. So you know darn well that there's probably more cameras out there than people are aware of. And apparently now 60% of Airbnb, I guess you could say, clients, people who use Airbnb regularly, are now worried about hidden cameras inside the Airbnb units that they're staying at. So again, that's a lot, and I would be worried too. It's a privacy issue. It just goes to show how as we move forward, how little things like the Baltimore ransomware and how like cameras and stuff like that can affect housing. It can affect stock prices, all sorts of things. So darn well that now Airbnb is going to have to do something about guaranteeing or ensuring that its hosts aren't doing illegal or immoral or whatever you want to call it, just privacy issue activities that would make a guest feel uncomfortable or be vulnerable in their stay. So very interesting. Yet one more thing we all got to deal with and we go forward. So keep that in mind next time you book your Airbnb. So having said that, thank you for watching today. Hope everyone's doing well out there. And if you need real estate information, please get in contact with me. As I said, I'm trying to get to people. The best way, honestly, is real estate. Okay, not real estate, is email. If you're going to contact me, email is the best way. A lot of times text and phone and calls I either miss or they get buried. So email is probably the best function to at least make initial connection with me, and we can talk or connect otherwise from there. So again, thank you very much. So I appreciate the likes, the shares, the comments. If you're not a subscriber, please subscribe and help the channel grow. And we'll look forward to talking to you in a couple of days. Thank you.